Ladies and gentlemen, good day and welcome to Mahindra Logistics Ltd. Q2 and H1 FY25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Shogun Jain. Thank you, and over to you, sir.
Joining us on the call today, we have with us Mr. Ram Praveen Swaminathan, MD and CEO, Mr. Saurabh Taneja, CFO, and the senior management team. I hope everyone has had a chance to view the financial results and investor presentation, which were recently posted on the company's website and stock exchanges. We will begin the call with opening remarks from management, followed by an open forum for Q&A. Before we begin, I'd like to point out that some of the statements made during today's call may be forward-looking. A disclaimer to that effect was included in the earnings presentation. With this, I'd like to invite Ram to make some preliminary remarks.
Thank you, Shogun, and good evening, everyone. I trust you all have had a chance to view our presentation, the financial results, which are available in the stock exchange and our company's website. I think I'll briefly talk about the external environment, our end markets, operational highlights by segment, and some key corporate updates for the quarter. Let me conclude by talking about financial performance in Q2 and H1 and our focus areas for the remainder of the year. So as we mark the third anniversary of the Gati Shakti program, there has been tremendous acceleration in the overall infrastructure and development of the sector. Increased capital investment by the government and the private sector rose from 0.4% of GDP in FY 2015 to around approximately 1%, which is around 3 lakh crores in FY 24. Over the last 10 years, there has been significant progress in development of national highways, which has increased 1.6 times in the last 10 years. The average pace of national highway construction has nearly tripled during this period, rising from 11.7 kilometers per day to approximately 34 kilometers in the current year. Additionally, toll digitalization has significantly reduced waiting times at toll plazas, decreasing from around 12 minutes to less than a minute over the last 10 years. And Indian ports have also been rapidly expanding their capacity to meet growing trade demand. Since 2014, the capacity of major ports has more than doubled. Improved connectivity driven by coordinated planning under the Gati Shakti National Master Plan, along with a strong emphasis on public-private partnerships, has significantly enhanced India's maritime competitiveness on the global stage. Reflecting this progress, India now ranks in the international shipments category of World Bank's Logistics Performance Index. India's rank has grown from 44 in 2014 to around 22 in 2023. The continued focus on the Gati Shakti program and its initiatives are critical for the sector and will continue to drive long-term acceleration for logistics. As India grows towards a $5 trillion economy, the logistics sector's long-term potential will continue to rise. Let me also quickly cover our end markets, and I'll begin with the automotive industry. In Q2 FY25, overall passenger vehicle wholesales decreased by 2% year-on-year, but grew by around 2% quarter-on-quarter. Passenger vehicle retail sales declined by 3%, with Q1Q performance also impacted by unseasonal rains and the sharp period in September, which is generally considered inauspicious by customers. In the two-wheeler segment, overall wholesales increased by 13% year-on-year and 5% Q1Q, which is a strong turnaround, with domestic wholesales growing by 13% year-on-year and 4% Q1Q. On the other hand, commercial vehicle sales remain subdued. Commercial vehicle wholesales are expected to decline by 10% year-on-year and approximately 3% sequentially, driven by reduced activity and a slowdown in infrastructure spending. The light commercial vehicle segment is anticipated to fall by 11% year-on-year with flat Q1Q growth. Despite festivals like Ganesh Chaturthi and Onam, dealers have reported stagnant performance, indicating underwhelming market sentiment with flat or negative growth trends. Adding to this, the unpredictable monsoon weather and the inauspicious sharp period have kind of further dampened sales during the quarter. According to the Federation of Automotive Dealers Association of FADA, passenger vehicle dealers are facing historically high inventory days of approximately 80 to 85 days, equivalent to around 8 lakh vehicles worth around 79,000 crores due to aggressive dispatches by OEMs. Looking ahead, the automotive sector remains cautiously optimistic, with Navratri and Diwali falling in the same month, raising expectations for a strong surge in vehicle sales. Our OEM customer base has seen mixed trends, with continuing trend of NPDs on non-production days in some cases, offset by continued strength in some other OEMs. Across the board, in our entire customer base, we see a strong focus on inventory improvement and management. Moving on to the FMCG segment, the worst seems to be over for rural markets, although momentum has not picked up significantly compared to the earlier quarter. However, a healthy monsoon has led to a good kharif harvest, which is expected to ease some of the persistent food inflation pressures. Our volume growth is anticipated to remain healthy, especially with the favorable base. As the festive season approaches in Q2FY25, a more sustained uptick in demand is expected. Additionally, a large portion of pricing declines in home consumption categories such as edible oil, hair oil, and personal care products is now behind us, providing further support for improved market conditions. While we see our customers showing greater optimism with a strong focus on growth in the networks, at sites and individual locations, volume remains soft and volatile through the second quarter, and we are optimistic to offer an uptick in the coming quarter. Moving on to the telecom industry, telecom operators announced tariff hikes at the end of Q2F25, and the impact expected to start reflecting in the coming quarter's results. As a result, performance is expected to improve sequentially, driven largely by the benefits of higher ARPUs. Additionally, capital expenditure remains stable compared to the previous quarter, supported by ongoing investments in 5G infrastructure and efforts to densify rural networks. The strong signals of growing investments on major 5G players bears well for value-added services and FTTH, NND, and distribution for the logistics sector. The e-commerce sector, we talked about a lot, so I'm going to focus more in terms of short-term trends. As we get closer to the peak period of the year, the primary focus for the sector has been on adding capacity across the networks and major marketplaces. Sales in the early part of Q2 bear reason for optimism, and we have seen an increased activity. However, at our customer end, the focus remains on improved asset utilization, with overcapacity in several products, given capacity additions done earlier in 2022-23 and 23-24. A secular area of growth remains quick commerce and groceries, with increased focus on expanding categories and the network. These segments also translate into higher growth from mid-mile fulfillment services. We remain optimistic for the quarter ahead based on demand trends shared by our major customers. The mobility industry has not seen any significant changes. Business travel remains strong, and the leisure segment is continuing to show positive trends. On the B2B side, we continue to see a slow return to office, and there has not been a significant change in the direction, which has been slow but positive over the last 4 quarters. Let me just move on quickly to our operating segments. In the interest of time, I will not cover all our segments, but we will answer specific queries you have on any of them later on in the call. I'll begin with third-party logistics, contract logistics business, or 3PL contract logistics business. The 3PL contract logistics business grew by 7% year-on-year during Q2F25, as several of our new sites showed volume growth. Our order intake was healthy, with an order intake of annual contract value of orders intake of nearly 200 crores during the quarter. We won several key programs, especially around fulfillment. For leading cosmetics players, we will be launching 4 new distribution centers in the coming 6 months. We also expanded with additional wins in grocery and quick commerce during the quarter, through which we'll be expanding our fulfillment center network for these segments. While new order volumes have been healthy, lower demand from current volumes and current sites had a dampening effect during the quarter, with weak demand both from FMCG, e-commerce, and auto OEMs. This has partially impacted the gains we registered from new accounts. During September, we had seasonal resource additions for the peak period, which starts for us in October. This is something which we do annually. This year, given the peak has split itself across 2 quarters in terms of resource periods, we saw a strong increase in September. The additional resources we've added nearly 6,900 seasonal resource workforce. in ramp up for the peak, and that has resulted in higher expenses during the quarter from 3 to 4 crores and impacted the earnings during the quarter. However, these should be offset in Q3 when we will see higher volumes based on the projections we have received from our customers. We do continue to invest in our warehousing network in the third-party logistics business. Cumulatively, our total warehousing space today is in excess of 21.6 million square feet. During the quarter, we commenced operations in Guwahati and Kolkata. Our new BPS in Agartala is under construction and is set to go live with partial operations in Q4. All 3 sites are anchor clients identified, and commissioning has already been completed in Guwahati and Calcutta. Overall, the white space in the business has come down marginally compared to the prior quarter. We currently have nearly 1.1 million square feet of white space, which has impacted our year-on-year earnings. These are on account of closures, mainly of e-com contracts post the 2023 Diwali peak. We have made progress on new sales of that space, and approximately 50% of the white space will be utilized by new orders and new projects which will go live by the middle of Q4 F2024-2025, and then we'll start being accredited to the earnings from that point onwards. Moving on to the freight forwarding segment, it was a period of recovery for us in freight forwarding, with growth in tonnage in most of our products other than air import. The growth was driven by new account additions, and penetration in existing accounts. During the quarter, there was a more favorable pricing environment, especially in terms of ocean freight, which has provided us a strong improvement during the quarter. While external environment remains volatile, we remain optimistic in the coming quarters given our acquisition of new clients and the growth we are seeing in some large contracts. I'll now move on to the express business. This was a challenging quarter for the express business. The demand environment, which was challenging in the prior quarter, remained weak with a lot of volatility and lower volumes from several clients. While we maintained a very low level and healthy level of account churn, we did see a 7 to 8% decline in volumes from existing customers on the back of lower business volumes which they had. New account additions of around 1,500 to 2,000 tons were also lower than what we had estimated, given the market conditions, as we had slower closures and delayed startups on the accounts. As a result of these, volumes for the quarter were generally flat Q on Q, and there was also a marginal impact due to lower sales to our retail customers or retail segment. While demand was a challenging situation for us, obviously we had a good quarter with strong continuing improvement in our on-time delivery rates and our service quality to our customers. However, volatility in sales resulted in challenges for us during the quarter with higher transportation costs as we saw peak volumes at the end of each month. Overall, this has been a challenging quarter for the express business. It's a business which is the critical part of our turnaround plan, was in the last and the current quarter. So it has been a challenging period. We have lost some ground on the turnaround plan. However, we have made good progress on underlying factors, and we remain cautiously optimistic about short-term volume trends. A few other corporate developments during the quarter. As part of our overall regional expansion, we are well underway in our Go East strategy, wherein we'll be adding nearly 1 million square feet of multi-client warehousing in Kolkata, Guwahati and Agartala. This is supplemented by the expansion of nearly 100 hubs, branches and delivery stations in our express and last mile delivery business, connecting the entire region. This should position us very strongly in our sector to serve what is generally considered a challenging part of India geographically. During the quarter, we also launched a new offering called Pro Trucking, which is focused on high-volume network transportation solutions for large multi-site clients. The offering has seen some positive customer adoption by 4 to 5 key customers, and we expect to further ramp up the offering in Q4 and early Q1 F25-26. As part of our green logistics offerings, we launched eDeal SAR, which is an industry-leading digital platform for visualization and monitoring of emissions. Supplemented by our circular operating system, sustainable warehouse and EV transportation services, this will provide customers an opportunity to measure and manage their carbon footprint, especially on Scope 3 emissions. With those general updates, let me quickly move into our financials for the quarter. From a financial performance perspective, I'll begin consolidated performance of Q2FY25. Revenue for the quarter was 1,521 crores, up 11.5% year-on-year. Revenue from the warehousing segments were rupees 306 crores in Q2FY25, up approximately 19% from the same quarter last year at 256 crores. That includes warehousing and integrated solutions. Overall, our supply chain management business, including our 3PL and network services businesses, which is freight forwarding, express, and last mile delivery, contributed 95% of our overall revenue, and the mobility business contributed 5% of our overall revenue. Gross margin at a fully consolidated business basis was at 9.17% in Q2FY25, down marginally from 9.25% for the same quarter last year. Gross margin without the impact of the express business was 11.4%. EBITDA for the quarter stood at rupees 66 crores, up from rupees 54 crores for the same quarter last year. Overall, for the quarter, we reported a loss of rupees 10.8 crores, an improvement over the same quarter last year, but a small marginal decline compared to the immediately preceding quarter. Now, moving on to components, revenue for Q2F25 was for MLL, which was 1,236 crores as compared to 1,135 crores the same quarter last year, up by approximately 7%. PAT for the quarter was rupees 8.5 crores as compared to rupees 18.6 crores for the same quarter in the prior year. PAT was impacted by two broad elements compared to last year. The first one was the seasonal impact of hiring for the peak. Last year, the peak was in Q3. And the second thing which has impacted us was the white space, as we had compared to last year when the 1 million square feet or so of space, which I referred to earlier, was fully occupied. Logs, which is our freight forwarding business, revenue for the quarter was at rupees 86.8 crores as compared to rupees 52.5 crores for the same quarter last year, up approximately 60%. PAT for the quarter rose sharply to around 2.1 crores as compared to a margin being marginally about breakeven for the same quarter last year. Our express business reported Q2 revenues of rupees 91.7 crores. It is reported under a subsidiary called MLL Express Services Private Limited. Total losses for the quarter in the express business were rupees 24.2 crores for the quarter, an improvement there of around 4% compared to the previous quarter. But trading obviously behind what we had initially estimated or targeted to for the quarter. The mobility business continues to move on its profitability improvement process. Revenue for the quarter was 81.1 crores. It was down compared to last year, largely on the account closure of some accounts and higher vacations and disruptions in the quarter, which resulted in lesser trips. PAT for the quarter stood at rupees 1.6 crores compared to 0.9 crores for the same quarter last year, up by 72%. Whizzard, which is our last mile delivery business, revenue for the quarter was at rupees 51 crores, up 46% from the previous year. PAT for the quarter stood at 0.2 crores. Whizzard, the last mile delivery business acquisition, Whizzard has now completed 3 consecutive quarters profitably. And we feel good about the scalability of the business going forward. 2x2, through which we run our assetized car carrier operations, the business has made a profit of rupees 2.02 crores in Q2FY25 as compared to rupees 1.4 crores. Okay. Revenue breakup for Q2F25, automotive business is approximately 57%, non-automotive is around 43% of our revenues. As I look back at the quarter, we have been able to start a sharper volume recovery with 11.5% year-on-year growth. That caps a challenging F23-24 where we had seen slower volume growth. Our subsidiaries are showing stronger traction and profitability in line with the long-term plans we made at the time of the acquisitions. We remain focused on driving improvements in 3PL to prior periods, driven by focus on reducing white space and driving more operating improvements and getting the MESPL turnaround back on track after what was a challenging quarter for us there. With that, I'll open it up for queries and come back towards the end of the call once again.
revenue.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handset while asking a question. The first question is from the line of Mr. Amit Dixit from ICICI. Go ahead.
Good evening, everyone, and thanks for the opportunity. I have a couple of questions. The first one is on contract logistics business. Just wanted to understand the quantum of unabsorbed cost in this quarter, because revenue seems to have grown, but gross margin hasn't. So I just wanted to understand that aspect.
Sure. Good afternoon, Amit. Do you want to just give us both your questions and we'll answer both of them together?
Yeah, sure. So one is this unabsorbed cost. The second one is essentially at Rivigo. What is the cash burn over there, and do we need to pump in more cash at this entity? These are my two questions.
Sure. Let me I'll answer both of them in the same sequence you asked them. So obviously, we did see volume growth overall in the contract logistics business, around 7%. Most of that volume actually came from new sites and new accounts on it. And our same site, so the way to look at this business obviously is we run long-term contracts for our customers and integrated solutions, warehousing and transportation. And these accounts have a certain running volume, and then we add new sites every quarter or every year. Because of slightly softer market conditions, especially on the automotive side, and some FMCG customers, our existing customers actually showed some decline in volume. And that obviously was one thing which impacts our operating leverage of those sites. The second thing which we did have a challenge on, but we had new sites which actually drove the revenue growth offsetting that. From a bottom line perspective, I think there are three broad drivers which impacted us. As I said earlier on, we had some impact because existing sites actually went down year-on-year on volume. That obviously got offset by new sites, but if that volume had not gone down, we would have been even better off. The second thing which is a challenge has been unabsorbed white space. Unabsorbed white space is approximately 1.1 million square feet, which is around 7.5 to 8 crores a quarter in terms of PBT at a pre-tax level. Okay? And the third thing which obviously impacted us was sequentially and year-on-year, Amit, was the peak impact. This year, because Diwali is coming in October, right, we have done most of the resource additions in September. The volume for that resource addition will actually flow through next quarter. And we've had a total, as I mentioned earlier on in my opening remarks, we've added around 6,500 people, right, on temporary contractual basis across around 97 sites which we run in e-commerce, 100 sites we run in e-commerce, and that has meant that we've had a 3 to 4 crore impact. Like in the contract logistics business, there's some amount of impact on last mile delivery business as well, but that's much smaller. So that's, I think, the broad run-up. I think it's big numbers obviously are the 8 crores of white space, and the 3 to 4 crores of the pre-season or the seasonal hiring. And that is much of your delta between last year, Q4, Q2, and this year's Q2. In addition, last year in Q2, we had other income which was sharply higher because of some one-time settlement of prior period tax cases. But those three are your principal waterfall elements from an earnings perspective. As you go forward, two out of other income will come and go, but I think the other two will basically get resettled. One is the seasonal hiring, which will go away in this quarter. And as I said, we've kind of already sold out half the white space, around third space. And obviously adding some new accounts as well. To your second question in terms of Rivigo, yes, the company is having a cash burn. We are, as you can see, the reported PAT losses of around 24 crores. On a non-cash basis, the losses are around 21 crores. Depreciation is roughly around 3 crores, and that is the burn which we are funding. We have capitalized the company. I think earlier this quarter, I think you have probably seen our stock filings. We are adding another 50 crores of equity into the company. We have a strong governance mechanism based on the long-term valuation guardrails to the business and what we put in our initial business plan, and we remain committed to funding the business. This has been a challenging quarter for the business. We are cognizant of that, but we think the underlying building blocks are in good shape. So we'll continue to invest in Amit as we try to scale up.
At this stage, any guess you will hazard for Rivigo to turn EBITDA positive, either third quarter or fourth quarter?
No, I think right now, let me put it this way. I last quarter also I said the same thing, Amit, and that we need around 30-35% more volume, right? And we say 30-40% more volume yield adjusted for us to redo EBITDA breakeven. Now, somebody asked me the same question last quarter as well, and I said that one of the risks which we carry is that the demand environment is a bit volatile. It was difficult last quarter as well. We were not expecting our existing customers to downgrade, which actually happened this quarter a little bit, and that's happened across all our businesses, frankly, with the exception of forwarding, cross-border business, and that impacted the express business a little bit more. We do need 35-40% more volume. That's been a consistent number I've said now from the quarter I think we acquired the company, right? And that's kind of the bridge which we need to match, to map. I think, and right now we are hoping to do that right around the 4 to 5 months. Right, and so somewhere in the middle of Q4 is when we should be able to do that, and there will be some burn which we'll have to fund over the next 2 quarters as well. That's something which we have partially capitalized with equity infusion we have done earlier this quarter, and then we will see how it goes from there.
Okay.
We are of course have been funding this through internal accruals.
Sure. Thank you so much, and all the best.
The next question is from the line of Janam Shah from Equirus Securities Private Limited. Please go ahead.
Yeah, Janam, good afternoon. Am I audible?
Yes, Janam, you can please go ahead.
So, sir, this question is related to Rivigo part only. So, sir, if we see, if we go back 2 years, somewhat where we have acquired the Rivigo, our plan to revamp the operation and make it EBITDA and PAT breakeven was quite mid of FY24. Then eventually market was not that great, or maybe a few players have become aggressive and gaining the market share, or maybe any other reason. The volume growth has not been that much, and eventually we have lost some market share in terms of volume. And while we are on the pick-up stage, I guess there has been 5-6% overall revenue growth which we are witnessing, and there has been a cost pressure as well coming from the overall macro environment. So from this angle, are we looking for any kind of thing which can eventually turn around for the Rivigo in near term, or is it more of an investment vehicle as of now for us, maybe for next few quarters, and then eventually turn it, making it profitable? So my observation would be that on a QQ basis, our revenue has increased by somewhat of 2.5-3 CR, whereas our EBITDA margin, EBITDA is improved by around half of that. So incrementally 50% EBITDA is flowing through from the additional revenue, but to make it profitable, 12 crore of EBITDA losses is still there. So what would be our overall, let's say, next 2-3 years perspective on the Rivigo?
So, Jerome, I think you answered much of your answer to your question actually is in your question, fortunately. I think when we acquired the company, obviously we had assumed, so 2 things have happened there. Obviously, since we acquired the company, one milestone which we missed was around smooth integration of the networks. We obviously had a challenge in integrating the networks, which is something which we carried from March 2023 till around August or September 2023, which was probably from the 4th or 5th month of the acquisition till the 10th month. That will take us time to clean up and fix. I think since then, from an operational or an offering perspective, we have been pretty robust. Our on-time deliveries have continued to improve. We are actually adding more capacity on some lines, on line hauls, to support the customer value proposition we provide. So operationally, I think we are in good shape. Obviously, we move nearly 6 to 7 crore packages through the network, and therefore you are not going to get it perfectly right all days. But it's operationally in a good place, right? And that's also reflected in the yields which we are getting from our customers. The challenge for us is to get volume up. Right, volume up is the story. I think from volume, in this quarter we saw better flow through from revenue to EBITDA. I think that's probably this quarter slightly on the higher side. I would generally say revenue to EBITDA flow through should probably be around 25-26%. This quarter was slightly higher for us. I won't use this quarter as a straightforward benchmark as well. But we need around that, I think we need a 35-40% more volume, and that's kind of that's the thing which will solve for it, Janam, and there's nothing else to it. That means obviously we've got to sell harder, we've got to deliver more in a cleaner way, and we have to drive better synergy with the rest of our businesses, because obviously we serve many accounts to the rest of our company and our other segments as well. We had hoped getting into the year that we would actually have we had a stronger Q4, where we saw some good order intake in Q4, and we are optimistic in Q1 and Q2, but market conditions have been weaker than we expected. That has obviously played a little bit through in our pricing, but for the large part it's affected, I think, our conversion more than our pricing. So at this stage, I think there is the focus purely is on getting our demand engine up to deliver the volume and driving the conversion. If we deliver that well, I think we think our volume will continue to have upside over the next few years. From a long-term perspective, I'll reiterate what I've consistently said, we do believe that from an end-to-end solutions perspective, part truckload remains a very important lever for customer value creation. And therefore, strategically, MLL is very committed to being in this space. We think it is very, very important for our company and its portfolio from a long-term perspective. In terms of the value proposition we hope to provide, the segment itself will have secured 13 to 15% growth. It's been a tough year. But if you look at the segment, it has been among the fastest growing segments within logistics. That's something which I think all of us in the industry continue to bear out. And we think that growth recovery will come back, even though it's in a couple of weaker quarters. And the third thing, of course, is I think from a valuation perspective, even with the additional investments we have made in, and it's something which when we made the acquisition at 0.6 or 0.67 times revenue, everybody asked us, have you got a really low cost deal? And we said it's kind of we purchased at low cost, but we're going to invest more, right, to turn around the business. And we are still roughly running around 1 time revenue, right, in terms of our total invested capital, debt and equity in the transaction, which we think is very, even fully including the losses. That's kind of level of investment we have made, and we think that's actually a very well-positioned investment value in terms of the portfolio and comps in the market and the industry. I think the focus right now is to get the volume back up, Janam, and I think if we can do that, we will be in a good place. We have a good order book. Order book quality is good now. That's one of the things which we had to clean up in the past. And therefore, that's in a much better shape as well, and we just have to execute on better volume. I think that's the thing, simple and not, it's easy and difficult, but that's, I think, the road in front of us.
Got it. So just one follow-up question. As we are talking about 35% or 40% volume growth to make it EBITDA breakeven, do we have the capacity for this kind of growth, yes, or we would be adding up more capacity for that?
Yeah, I think it's a mixed bag. I think at sites, Janam, we have the capacity. That's one of the reasons that profitability will go up. So capacity is two things. It's transportation and it's processing centers. At processing centers and facilities, we have the capacity. We might add a few shifts, right? But by and large, we have the capacity. Transportation right now, the line haul network is running at around 85% utilization, 80-85% utilization. Utilization came down a little bit this quarter because we ran more lanes given takt time requirements. So that is the headroom is available in the network, and beyond that, we'll have to add capacity as volume comes.
Got it, sir. That's it from my side. Thank you so much, sir, for the elaborate answer.
The next question is from the line of Saras Singh from Haitong Securities.
Hi, Saras. Good evening.
Hi, good evening. So I just had one bookkeeping question. So what was the volume in the express segment for the current quarter?
I think around 64,000 metric tons. 66,000 metric tons.
66,000. So that's is it correct to say that over the last quarter we've seen a dip, a slight dip, because last quarter I think we mentioned a decline of about 8%. from quarter on quarter sequentially. Is that correct? Is there a further dip from the previous quarter?
So I think we were down in Q1 versus Q4. We were down 7.6%. This quarter we are up by around 2% in terms of actual volume moved. From a yield perspective, the yield was slightly down this quarter because we had a higher mix of enterprise versus retail, and that was an impact. The overall volume in the quarter actually grew by 2 to 3%. Pickup volume is actually higher, Sarath. We actually picked up more volume, but delivered volume grew by 2 to 3%. Pickup volume grew by even higher, but given the volatility with the end of month swings and seasonal and weather challenges through the quarter and more holidays, we obviously did not. We had a higher gap between pickup and delivery. But delivered volume is up 2% to 3% compared to the sequential quarter.
Okay. So for Q3, just a basic question, can we expect some seasonality for the PTL business as well in Q3?
I think we're expecting. I mean, to be honest, Sarath, I think that the three parts to it. There's obviously seasonal demand which comes from our retail network and our existing customers. There is obviously existing customer account volume, and the third one is new account addition. What I think was a challenge for us in Q2 was just the fact that given the overall economic environment, several of our accounts just downtraded us, not because they were down, because we lost share. Their volumes just came down, right? We are hoping that will come back for us. I mean, that to us is the biggest immediate lift because those are accounts we're already working on. It's actually volume is serviced at a higher level. If you see the dip, if you go back to Q4, the dip versus Q4 is actually a lot of it is that. So hopefully that volume will come back. We're optimistic it will come back. I think it's still early in October to call it, but I think as we get closer, right, I think we'll be in a better position in a couple of weeks to be able to talk about it more clearly. But we are expecting obviously a seasonal lift from our accounts.
Got it. Thank you for the answers and best of luck for the upcoming quarters and happy Diwali. Thank you.
Thank you. The next question is from the line of Krupa Shankar NJ from Avendus Spark. Please go ahead.
Well, thank you for the opportunity. So, Ram, couple of questions. First one on the, is there any one-off relating to flex warehousing which has impacted the 3PL margins this quarter?
No, Kripa. I think as I outlined earlier on, firstly, I think flex in general has come down in the sector, in the industry. I think if you notice, our peaks are just getting longer. I think festive sales are just getting longer, and you will see it across the board, except for grocery and quick commerce, most of the marketplace are running slightly longer sales. And if you look at delivered dates on those, you just see a slightly more stretch out on that. So I think inherently, the kind of demand for flex is, the demand growth of spurt is not there to justify flex right now. And a lot of it is just being handled operationally. So it's not there, and there are no one-offs this quarter. I think the impact clearly compared to last year, Kripa, has been the white space. I think I mentioned there's been white space of around 8 crores. Obviously, the additional impact of seasonal hiring of around 3 to 4 crores. Those are the two big headline numbers. There's obviously been lower in-site volume that's been offset by some of the growth as well, year on year. But these are the two big drivers in the 3PL business which have moved volume out. I think the seasonal hiring is an issue of September, which will basically kind of unwind itself in the coming 3 months, and you should see an uplift from it as a built-up capacity. And I think the white space or the unsold warehousing, we have contracted more than half of it already, so you should see that come down in its impact over the next couple of quarters.
Understood. Also, Ram, with respect to last mile delivery, are you seeing the growth trajectory improving substantially from here on? Because when I look at the capex numbers, I was quite surprised to see that the capex incurred in the first half is pretty much quite on a higher side in comparison to our past. So is it more to do with this last mile, or is it? Can you just give us a breakup per se as to what are the target areas?
No, so I think so I'll answer the question on last mile first, because there's really not much of an impact on last mile. Last mile business has grown healthily. I think it's benefited from specific segments we are working on, like grocery and new account addition. I think the Wizard business runs, we think through the Wizard business, we run a very cost-efficient model, and therefore it's not a very capital-intense business. I think during the first half of the year, we have spent an increment in capital that's largely been on account of two things. Firstly, I think, and if you see our 2x2 results at a subsidiary level, we have added around 75 vehicles to our 2x2 fleet, which is an assetized truck fleet, which we run for car carriers, and that fleet's been fully deployed. As you can see that the benefits of that showing up in the results partially in this quarter. There's some more headroom to go as the vehicles get fully utilized. I think the second piece of growth has really been that, as you've seen, our warehousing revenue has grown by around 20% year on year despite the challenges, and we are adding more offerings and solutions there. And that has seen some amount of capital in the quarter. We have gone live with a couple of new sites in ramp-up for peak. And that has been the other part which has added capital as well. So if you generally see our general capital pattern, Kripa, you go back and we've been on this talk for quite some time. We've generally been a 65-35 kind of company, 65% in the first half, 35% in the second half, because a lot of our cap addition has been lined up to that festive season. Right. So we are up this year, but if you take out the fleet addition, I think we are still pretty much in line. We've been a 1.2-1.3% kind of capital investment model, and I think we are generally in that range still. In terms of the first half of the year, I think the second half of the year we will actually probably see some additional capital investments. We are working on some several large projects, and if those materialize in terms of demand, we should see a higher capital flow there. We are also looking at kind of some fleet addition, more addition to 2x2 business. We should also probably, given the strong demand we're seeing in car carriers, and some of those things will probably add to our capital addition as well. Again, as you mentioned earlier, capital spend is generally governed by earnings guardrails, and we don't approve projects if they're not in line with those guardrails.
Understood. Thank you and all the best.
Thank you. The next question from the line of Alok Deora from Motilal Oswal. Please go ahead.
Hi, Alok.
Hello, good evening, sir. Just a couple of questions. So, sir, just few quarters back, you had mentioned that, the tonnage is around 70,000 or so, and we need to get towards 1 lakh tons kind of a run rate to achieve break-even. And in the current market scenario, where most of the companies are talking about at best kind of a single-digit growth, they're recouping a 35,000 tons quarterly incremental volume seems pretty far-fetched. So is it fair to assume that this would be a much longer drawn process here, because unless we reach around 95,000 or 1 lakh ton, the break-even seems not happening. So just some thoughts on that. I know you have spoken in detail on Rivigo, but just if you could highlight it in terms of the tonnage. Yeah.
No, absolutely. Look, I think all the data points I think said are all accurate. I think we had said when we were around 71,000 tons, we had said we need around 30 to 35% more. We said 95,000 to 1 lakh. There was Q4 of last year. We obviously projected we were down 7%. In Q1, 7 to 8%. We're up 2% to 3% this quarter. So that's just like this is getting up baselining. All of us on the same page in terms of baselining. We do obviously need to get around, 30% more, which is around from that 65,000, 70,000 on 30% more, and that still remains the North Star, if you will, towards to be EBITDA positive. In terms of the challenge of the market, I think the challenges you articulated also are fairly accurate. If I look at last quarter, look, I think you had asked the same question last quarter, and we said that we need approximately 5,000 tons a month, 5,000 tons a month of growth every month to be able to hit that number or in terms of growth. Last quarter, we did see around 2,000 tons of additional order intake. So it was not that the order intake was bad. I think our challenge was that our existing volumes traded lower. And that means that we obviously have to reset our volume growth targets to higher levels. We are investing more in the front end of the organization to drive that a lot more. We're also trying to drive better synergy between our 3PL business and our express business. But the risk on volume remains, right? I think the question, I think Jainam asked earlier, and he asked us to maybe timestamp a date. And I think I told him that it's a bit hard right now to timestamp an exact date. I could just give you a date for the sake of giving you a date. But, it wouldn't really help. We do need to get to a 35% volume growth. I think as we see it right now, this is what we're seeing in terms of a run rate of order intake, what we're seeing in terms of churn levels, and what we see as a pipeline, both of converted orders which are yet to trade and new conversions we have. We think this will basically be a window through February or March. Okay. And as you pointed out, I think we acquired somebody else's point of the company. We are expected to break even, towards the end of 24, right? And we are now looking at probably break even at the end of 25, which is like a 12-month delay, right? Based on the current visibility we have. But the volume environment is challenging. I won't undermine that at all. We have people who it's a challenging quarter for us, but I think we have some high probability line of sight to getting to that volume by February or March.
Sure. Sir, how has October been in terms of tonnage? Even if you can't share the absolute tonnage, but have we seen the incremental, whatever, 2, 3, 5,000 tons coming in October?
We've seen some marginal improvement on traded volume in the first 10 days, 10, 15 days. I think we will probably get to see that. As you know, I think there are two things here. There's pickup volume and delivered volume. Right, so we have seen an uptick on the pickup side in terms of what we have picked up from our customers. We are seeing some stretch on deliveries. So hopefully we will have a better sense of that towards the end of October.
Sure. Just a last question, sir. So, sir, I mean, see, first quarter we were down 7% QOQ, then we are kind of a flattish in second quarter. And now, as per the revised sort of a guidance in a way that you're telling that by FY25 end we will break even. So that would mean that we are looking at a 1 lakh or a 90,000 sort of a tonnage materializing by end of this year. I mean, if we are growing at 2% or 5% or even 10% or even 15%, that my growth might not, the tonnage might not really materialize, right? So because I mean, frankly, most of the companies are talking about 5 to 10% at best in the second half. So are we talking about a big market share gain here? Because I mean, 66,000 moving to 90,000 in 4-5 months. I mean, that seems pretty challenging.
So I think, I mean, first, what I do agree with you that it's a challenging task. Just to get the numbers aligned, it is 65 in the quarter. Going from 85 to 90 in a quarter. So it's around 6,000 tons more per month. Right. So in that sense, it's not a step up change. If you remember, we're still trading on 5% lower than what we were in Q4.
Yeah.
Right. So that's kind of part of what we have to get back in. We have to get that number in, and then we have to go from there. So it is a challenging environment right now. As I said, well, I think this is our best line of sight. There are challenges in volume for sure. Right. But we have a high probability line of sight, and we are working it. Right. Can I guarantee it? Obviously, it's hard for us to guarantee anything, but right, we are working it based on what we see as probabilities, and our pipelines are pretty strong.
Yeah, absolutely. No, the only reason this becomes very significant part of your.
Absolutely, I understand.
So that's the only thing, because we are already delayed by kind of a year And
Yes.
still, we still see it difficult materializing in next 6-9 months. So, sure, no problem, sir. That's all from my side. All the best.
Thank you.
Thank you. The next question is from the line of Ankita Shah from Elara Capital.
Yeah, hi, sir.
Hi, Ankita.
Hello. Sir, I want to question this last line that you mentioned, high probability of line of sight. Sir, in terms of volumes of what we didn't see so far, what will change so suddenly that gives you so much of confidence on the growth in volumes? Also, even if I look at your pricing, on an average, your pricing is not very competitive as compared to peers as well. So what is the USP or, I would say, what is the driving this confidence in terms of volume growth from there on, if at all it comes?
So I think we're going to come back to the same question in different perspectives, right? But I think what gives us confidence right now is three things. The first one, I think, as I said earlier on, we are still 5 to 6% trading lower than what our earlier volumes were. Right, in Q4, most of that has not been share of, has only a competitive loss in terms of market share of those accounts or share of wallet of those accounts, existing accounts which have been downtailing their volumes in general. As those come back, and so there is some confidence which we have got from their conversations with them, that's approximately the 15% to 20% this delta we need to bridge. The second thing I think is, and you know the industry very well, Ankita, because you've been working with many people. Obviously, when we close orders, we don't obviously get immediate conversion of all those orders. It takes us some time for us to get an order converted into full tradable volume. Given some of the challenges in the market, that period has got stretched out. So if you look at what we have won or signed up in terms of contracts every month, it's probably around 4,000-5,000 tons per month of contracts already being signed up. But only around 30% of it actually flowed into our books. Right? So obviously the second part which gives us confidence is that we generally we are not seeing any customer issues with accounts. So we are hopeful that we actually that will change into our volumes in the coming 3 to 4 months. And the third one obviously is new account addition. So if you actually break the 6,000, which I know is a large number and seems very large too, in that I think the 15% of it is recovery from existing accounts we've had. Around the 50% of it is actually driving more volume conversion from contracts we already assigned. Right, and the remaining 1/3 actually is new accounts which we have to win. Right, so that's what gives us confidence. I think on pricing it's a mixed bag, Ankita. I'm not as far as competitiveness of pricing. I think the pricing corridor is large on partial load. I think there are players who are aggressively, obviously pushing price to get volume. There are people in regional PTL, for example, who actually price at even lower levels. So it's very difficult to technically call our competitiveness of pricing without looking at our value proposition. I think our value proposition is simple. Like we deliver more direct pin codes than many others do. Right, and on the delivered pin codes we deliver directly, which is around 8,000 of our 19,000 pin codes. We actually do have very good tax, we believe, very good turnaround times and delivery times, and I think our service quality and our depth quality is pretty good. Now, that's one of the reasons why I think we don't see much of our in-customer accounts actually pushing heavily on price reductions. I have said consistently that we will not chase price. We will not aggressively use price to build volume. Right? We are confident about our ability to drive the proposition to create volume for the business. And that's something which we'll hold the line on. Right, tactically, of course, that doesn't mean that we will not adjust volume for specific customers or very large volumes or for specific geographies where we need backhaul or we need specific volume. But by and large, our approach is not to undercut competition or undercut existing pricing to actually build volume for ourselves. Right, and that's something which we will remain consistent on. But that's actually why we think we have line of sight on it. That's like a longer answer, Ankita. The proof of the pudding is in eating it. So we have to wait.
Got it. So secondly, the debt has increased in the first half of the year. Does this already take into account the capex and the 50 crores of additional investment required, or is it over and above the first half of the year?
I think Ankita, almost completely. That's taken almost account. Obviously, part of the increase is because I said we bought 75 new car carriers, which are quite expensive. For the 2x2, that's fully in the numbers. I think most of the capital investments we have made in the 3PL contract logistics business is completely in, right? And obviously, for the large part, we also do the MLL express funding as well through internal accrual from MLL, and that's largely in those numbers as well. That doesn't show in our debt as much.
So the loss funding is not included in this?
No, loss funding is largely included in these numbers. We do that out of our accruals. We don't borrow for it. Till now, we've not borrowed for it.
So because the core business is also loss-making, so obviously everything is going into that only, right? Incremental funding. Core business as well as this.
Ankita, Saurabh here, just to clarify, the core business generated 140 crores of cash flow from operations.
You're talking about SCM business.
Yeah, I'm talking about the MLL standalone entity. It generated 140 crores of cash in the first half of the year, which was used to fund the equity funding as well as the capex expansion that you.
Actually, I think I would just suggest you can look at the financials in a bit more detail and send us questions.
Done. And lastly, the work from home. You said the work from home has not fully recovered, but sir, last year FY24, so we were seeing a growth in the mobility segment, and I think in one of the calls you had mentioned also that a large part of the airport business is back to pre-COVID level. Then why are we seeing slowdown in MLL mobility for the last 2 quarters?
Yeah, it's a good question. I think in the express business, the mobility business, around 15 to 20% of our business is the Meru brand-based B2C business. Around 80% of it is express, is enterprise mobility. I think during the quarter we saw the full impact. Our Bangalore-based airport business came down because the contract with the Bangalore airport was awarded to somebody else. When the renewal came in earlier this year, and that impacted our B2C volumes during the quarter. And that's the impact we're seeing year on year. The B2B business actually is in very stable shape, and it's not grown as much as we expected because we've not seen a pickup on return to office. But it's in pretty good shape, and that's actually why you see the profitability, right, is in a very stable shape, and it actually improved year on year. It's also sequentially in very good shape. So we are working obviously on strategies now to expand the B2C business, but obviously when we lose an airport counter, it has one spike or one sharp dip or one sharp spike. Even in airport we get a sharp spike, we lose an airport, we get a sharp dip. So that's kind of a time of period impact. But the core part of the business, which is the larger part of the business, which drives our revenue and earnings growth, is the B2B business right now, and that is the one which I think consistently last year I told you that the B2C business is back, in fact, is growing, right, compared to pre-COVID levels, and I think that's something you can see in terms of passenger traffic data. The B2B business is where the recovery has been slower, and that is still crawling. We've just not found the second step up. We've got the first step up around August last year, and we are still waiting for a big step up to happen again. Many of our accounts are projecting more employees coming into work on a full-time basis, but we have not seen that work.
Okay. Thank you. That's it from us. All the best.
Thank you. We will take the last question from Mr. Achal Lohade from Nuvama Institutional Equities. Please go.
Hello.
Yeah, good evening. Thank you for the opportunity.
Hi, sir.
So the first question is, on the supply chain business. You did mention that there have been some reduction in customer count and some additions. What is how many customers we kind of seen unwinding, and number 2, what kind of impact did it have in 3Q?
in 2Q actually. If you not come to 3Q yet, actually hopefully there will be no impact.
My bad.
I hope so, right? But in 2Q, just to clarify, that we've not lost any, we didn't have a drop in customers. We actually had a drop in existing customers' volumes. Right, so obviously we run facilities and networks for our customers as well, and if their volume comes down, the volume we process comes down. Right. So if we run a warehouse and we deliver, 50,000 packages, from that if their volume comes down, it becomes 40,000. Then we obviously to that extent lose some margin and revenue from that additional 10,000 that got. Right. So during the quarter we did see that impact. It was a mixed bag across multiple sites. On the automotive side, obviously, as I mentioned earlier, we had more non-production days, or no production days in our accounts, and that obviously meant our unpaid revenue from those businesses. Many of those we do on a price per vehicle, price per car, price per truck basis. So we obviously saw some impact of that. That was on, I don't have a specific number, we can pull out a number, but probably I would say it's probably around $200,000-$300,000, 2-3 crores, right? Of impact, right? That obviously got offset by the growth we had in volume, right? So obviously we also had a 7% growth in volume, and that 7% growth in volume obviously offset that and a little bit more. That I think was the largest. That was the impact there. I hope I answered that question.
The 7% is post the volume reduction in the existing customer, or is it the new?
Revenue grew by 7%. Which obviously had some negative impact of revenue and obviously positive impact of revenue. Generally, what has happened actually is when we launch a new site, it doesn't get peak earnings on day one, right? So first 3 to 6 months, earnings are going to be lesser than peak earnings. And therefore, you will see it's not apple to apple. I mean, dollar lost in existing site doesn't always add up to the same margin as a dollar won on a new site.
Understood. Secondly, in terms of the sectoral mix, you did say auto is 57%. Would it be possible to know what are the other 2-3 large sectors?
I think mobility is on 5%, as you know, okay, on the overall company, and the remaining 40%, 39% is basically split the half roughly. 20% of that would be FMCG durables and pharma, and 19% would be e-commerce as an end market. E-commerce is served both by 3PL business, our freight forwarding business, our express business, and our last mile delivery.
Understood. And just one more question, if I may, with respect to quick commerce. How large is this for us at this point in time? And B, in terms of the opportunity, in terms of the growth, how do you see it evolving, and is it margin accretive, margin dilutive for us?
The last one is a simpler answer, is margin accretive. I think the way to look at the space actually though is that I think the quick commerce side, we don't do too much of last mile delivery in quick commerce. We largely do fulfillment. Right, so as you look at quick commerce, I think that's an important distinction to make. So we are fulfilling into dark stores. We run some dark stores, but we've done very few dark stores in delivery. We have operating model constraints on how we operate that, so we don't do too much of that. On the fulfillment center side, obviously, that's the number of stores which are there. And that business is fairly large for us. I don't have an exact number actually. You probably can mail us and we can send you a more specific number. But we are running, I would say probably around a reasonable number of fulfillment centers into the space. And it's a growing space for us. I think that space as the quick commerce companies tend to add more dark stores, right? You should actually see obviously more demand for fulfillment as well, because those dark stores are to be fed by someone. So we are obviously expanding. That's one thing. The other thing I think is quick commerce is also expanding the selection, right? So it's moving from just groceries or food items or kind of the experiential plus to actually more to other things as well, like electronics and so on. And as that selection broadens, the density of fulfillment requirements has also broadened. And therefore, right now, we are expanding for a couple of them, and we are setting up several new fulfillment centers for them across multiple cities in the country. I'm not at liberty to talk about specific details. In terms of revenue contribution, Achal, if you can send us a note to SG or our investor connects. We will send you a more specific one.
Sure, will do. Thank you so much and wish you all the best.
Ladies and gentlemen, in the interest of time, that was the last question. I would now like to hand the conference over to Mr. Ram Praveen Swaminathan for closing comments.
Thank you all. I hope we've been able to answer all your questions satisfactorily. However, if you do need any further clarifications, do send us your questions. You can contact our team or SGR Investor Relations Advisors. Thank you all for your continued interest in the company, and I want to take the opportunity to wish you all and your dear ones a very happy Diwali and a very safe one. Thank you, and thank you once again for taking the evening to join us.
On behalf of Mahindra Logistics Ltd, that concludes this conference. Thank you for joining us, and you may now disconnect your line.